In this webinar, we are going to discuss the question of risk in the share market. Let us begin with an inescapable investment truth. To make a real after-tax return, you have to take some kind of risk. In fact, I don't like risk-free investments because they are also return-free, especially after you take off inflation and tax. Making a real after-tax return on your money always means that you will have to take some level of risk. The secret is to use your knowledge, understanding, and experience to reduce that risk to an acceptable level. When you buy a share, you are immediately in the business of forecasting. You are hoping and predicting that the share will go up. But of course, when you buy a share, someone else sells it. And that person has exactly the opposite point of view about the same share on the same day at the same price. He thinks it will go down. Of course, only one of you can be right, and whoever is right will take money away from whoever is wrong. And the whole thing depends on the quality of your prediction at the time that you make the investment. So how can you make sure that you are right? The answer is homework. You must take the time and trouble to really get to know the share that you want to buy, by studying its financials and its charts, considering the industry that it is in, and trying to visit its place of business, if you can. In addition, you must decide whether the market as a whole is in a bull trend or a bear trend. Are shares generally going up or down? What you are trying to do is to make sure that the risk you are going to take when you buy the share is in proportion to the return which you can expect to make from it. And that brings us to another great investment truth. Risk and potential return should rise together. The best way to understand this is to think of two investments which have exactly the same return, but one is much more risky than the other. Which would you choose? Obviously, if the returns are the same, then you would choose the one with less risk. That is just common sense. So investors generally have to be offered a higher return to induce them to take on riskier investments. Return is a relatively easy thing to measure. If you are not sure about how to measure return, refer to our webinar on the subject. Measuring risk, on the other hand, is very difficult. There is no really good way to measure risk, because that would involve being certain about what is going to happen in the future, and nobody can do that. In fact, the only way to predict the future is to study the past. The only reason that you know that the sun is going to rise tomorrow is because you have seen it happen before. If you hadn't, you wouldn't know that. Let us consider the path of a share's price and ask ourselves the question, what would be the easiest chart to predict? Well, obviously, that must be a straight line. The most predictable share would have to have a price chart that rose steadily and consistently in a gently sloping upward straight line. Therefore, to the extent that a share's price chart departs from that straight line, it becomes more volatile and hence less predictable and more risky. So now we can identify another great investment truth. Volatility equals unpredictability equals risk. Of course, when a share price chart is more volatile, you will have more opportunities to profit by buying low and selling high. So that comes back to our earlier truth that risk and potential return rise together in tandem. So what causes the volatility in prices? There are two primary types of risk, systematic and unsystematic. Systematic risk is the risk which impacts the market as a whole. For example, the risk that there will be a worldwide corona pandemic, or the risk that Eskom will fail completely. Systematic risks tend to cause the entire market to fall, so they are best analyzed by using market indexes like the JSE Overall Index or the S&P 500 Index from Wall Street. Unsystematic risks are the risks which attach to a particular share. For example, the risk that the company whose shares you want to buy will become unprofitable for some reason. And each type of risk, systematic and unsystematic, can be considered either fundamentally or technically. At the start of this webinar, we suggested that the way to reduce risk is to do your homework. Now we are telling you that you will have 4 different types of homework to do. Firstly, the fundamental analysis of the systematic risk. Here you will be building your own opinions about the drivers of national and international economic growth, such as the level of inflation, the level of interest rates, the balance of payments and international trade, the impact of technology, and many other factors which determine the health of our economy in the context of the world economy. Secondly, you will have to analyze the technical side of the markets. This means charting the indexes of both the local market and the international market. Indexes are the averages of the performance of that market. The most important of these is the S&P 500, which is a weighted average of the 500 largest companies trading on Wall Street. The other markets throughout the world take their lead from Wall Street. There is an old saying, if Wall Street sneezes, the rest of the world catches a cold. So various indicators can be applied to the indexes to determine whether they are overbought or oversold in relation to their historical performance. Thirdly, the fundamental analysis of the specific share that you want to buy. This begins with the analysis of the company's past and potential profits and dividends. From there, it drills down into the specific factors that will generate that profit, such as the quality of its management, how well it manages its working capital, its exposure to union action, and to the strength of the rand, and many other factors. Finally, you will need to spend some time on the charting or technical analysis of that same share. This begins with a basic candlestick chart of the share's price, and then looking for formations and areas of support or resistance, and then it goes on to the use of a variety of mathematical tools, known as indicators, to identify patterns which may be useful in determining future trends. So those are the 4 areas of your homework. In this training program, we will take you through each of these different areas in detail and explain how to get the most from them.